On March 11, 2025, the United States Mint announced a temporary halt to its American Silver Eagle coin production. This was not a mere slowdown, but a complete cessation. The stated reason was supply chain disruptions. By March 18th, the Royal Canadian Mint had implemented an allocation system for its dealers, meaning customers could no longer order the quantities they desired, but rather received what the mint permitted, a situation unseen in 37 years. On March 23rd, the Perth Mint in Australia extended its delivery timelines to 16 weeks, a 4-month wait for a product that previously shipped within 3 days. What is not being widely reported is that these are not isolated incidents, but rather a coordinated collapse. The world's leading silver mints are currently depleted of physical metal, and when these mints cease operations, the entire retail silver market faces obsolescence. Over the next 15 minutes, the 3-tiered supply chain currently disintegrating in real time will be detailed. Firstly, primary refiners are unable to secure sufficient raw materials. Secondly, mints are experiencing shortages of refined blanks. Thirdly, dealers are struggling to obtain finished products. Each segment is failing concurrently. This will be substantiated with production figures, delivery schedules, and premium spreads, painting an irrefutable picture. A supply crisis is not months away. It is weeks, possibly days, away. Observe how the system is faltering. The initial stage, refiners facing raw material scarcity, is the origin of the problem. Raw silver originates from 3 sources: primary extraction, byproduct recovery, and recycling. All 3 are currently experiencing failures. Global primary silver mines, numbering 23 and producing over 5 million ounces annually, collectively yield approximately 200 million ounces per year, representing only 20% of global supply. The remainder is derived as a byproduct of base metal extraction. The critical issue is that primary silver mines are not expanding. They are contracting. For example, Nilo in Mexico, the world's largest primary silver producer, reduced its 2025 production forecast by 8%, not by choice, but due to declining ore grades. The easily accessible silver has been depleted, leaving deposits that demand more extensive processing, greater energy expenditure, and increased costs for diminished yields. Pan American Silver, the second largest producer, has postponed expansion projects, citing permitting challenges and capital limitations, effectively meaning they cannot justify substantial investments in new deposits when base metal prices are subdued and silver prices have not offset rising operational expenses. Kerr, Hecla, MAG, Silver, and other major primary producers face similar predicaments: declining ore quality, delayed projects, and reduced output. This applies to the highest grade, most easily processed silver globally. If primary producers cannot augment supply, what about byproduct mining? Byproduct mining accounts for 70% of global silver supply, originating from zinc, lead, and copper mines. Miners extract base metals, with silver being an incidental component. Consequently, silver availability is contingent upon demand for base metals, which is currently weak. Copper prices are volatile, zinc prices are depressed, and lead prices are stable but stagnant. Mining enterprises make capital allocation decisions based on the economics of primary metals. If copper is not sufficiently profitable to justify a new mine, that mine will not be developed, and the accompanying silver will never be produced. This is a structural issue. A silver deficit cannot be resolved by merely wishing for more silver. It necessitates a surge in copper demand, a spike in zinc prices, and expansion in lead mining, none of which are occurring. Major diversified miners like BHP, Rio Tinto, and Glencore project no new significant silver byproduct projects coming online before 2030, a 5-year horizon. The supply constraint is not temporary, it is entrenched. Recycling is presented as a potential solution, involving urban mining and reclamation of silver from electronics, solar panels, and industrial waste. However, this avenue is underperforming. The Silver Institute reports an 18% recycling rate for electronics, meaning 82% of silver used in devices is not recovered due to the uneconomical extraction of minute quantities, especially when the device itself holds greater value in its components. Solar panels are a more significant issue, locking away silver for 25 to 30 years. Even at the end of their lifespan, panel recycling is costly, and most end up in landfills, rendering their silver unavailable for decades. Industrial waste recycling offers better recovery rates, perhaps 50%, but industrial processes are increasingly optimizing for reduced silver usage, not generating sufficient waste to have a substantial impact. The economics do not align. Recycling contributes an estimated 150 million ounces annually, while global consumption stands at 1.2 billion ounces. Recycling is not addressing the deficit. Therefore, with primary mining declining, byproduct mining stagnant, and recycling insufficient, refiners face a diminishing raw material supply amidst escalating demand, creating the initial bottleneck. Refiners are informing mints of extended delivery periods. What was once a 2-week turnaround from order to refined blank delivery has stretched to 6, 8, or even 12 weeks. This is due to refiners' lack of material to process. They are actively sourcing scrap and engaging in competitive bidding for limited feedstock. Major Swiss refiners like Herias, Metalor, and Valcambi are reportedly offering premiums above the spot price, sometimes $2, $3, or $4 per ounce, simply to secure supply. This premium is subsequently passed on to mints, dealers, and ultimately consumers, and this trend is expected to intensify. This constitutes the first layer, where the foundation is eroding, with refiners unable to procure adequate raw materials to satisfy mint demand. When refiners falter, mints cannot produce, leading to the second layer. In the second layer, mints are unable to obtain refined blanks. Mints do not mine or refine silver themselves. They purchase refined blanks from external suppliers and mint them into coins and bars. A lack of blanks directly translates to a lack of production. Currently, sourcing blanks is becoming exceptionally difficult. The United States Mint, the world's largest sovereign mint, announced in March 2025 a temporary suspension of American Silver Eagle production due to supply chain disruptions, which essentially means they cannot procure blanks. The mint sources these blanks from a select group of approved refiners, including Sunshine Minting and Ohio Precious Metals. These refiners are unable to meet demand as they are being outbid by private mints offering higher premiums and by foreign governments securing supply for their own mints. Industrial consumers are also locking up supply through long-term contracts. The U.S. Mint is bound by government procurement regulations and cannot simply offer any price. They operate within budgetary constraints and face bureaucratic approval processes. While they navigate this red tape, other purchasers are acquiring available supply. Consequently, American Silver Eagles, the most recognized silver coin globally, are not being produced. This is not merely a supply chain issue, but a fundamental supply problem. There is insufficient refined silver to meet demand. The Royal Canadian Mint is experiencing a similar situation. Their implementation of allocation systems means dealers can no longer simply order 500 maple leafs for next day's shipment. Instead, they must submit requests and are then assigned an allocation, which might be significantly less than requested, or even none at all. This is because they lack sufficient blanks to produce an unlimited number of coins and are rationing production based on available material. Delivery times have extended from 1 week to 12 weeks, a 3-month delay for a product traditionally in stock. These are not shipping delays but production delays, as they cannot mint coins as quickly as they can acquire raw materials. The Perth Mint in Australia is quoting 16-week delivery times for standard products, and some items are entirely unavailable, indefinitely suspended. Perth is a highly efficient mint with considerable capacity and machinery, but it lacks feedstock. The most alarming aspect is that these are sovereign mints, government-backed entities with substantial capital, established relationships, and preferential access to supply. If they are struggling, private mints are facing even greater challenges. Smaller operations producing generic rounds and bars rely on spot market purchases of blanks, and these are now unavailable. Herias ceased accepting new blank orders in February. Metalor is quoting 20-week lead times, and Sunshine Minting is prioritizing existing clients while turning away new business. 3 private mint operators have confirmed their inability to procure materials and are depleting existing inventory. One operator stated they have approximately 6 to 8 weeks of blanks remaining before they must cease operations until supply improves, which is unlikely. This situation creates a cascading failure. The U.S. Mint halts production, leading dealers who relied on Eagles to shift demand to maples. The Canadian Mint, overwhelmed, tightens allocations. Dealers then turn to Perth products, resulting in extended delivery times. Subsequently, they seek private mint generics, but these mints also run out of blanks, leaving dealers with nowhere else to pivot. The entire retail silver market then seizes up. This scenario is weeks, if not days, away, with some mints already experiencing these conditions. When major mints follow suit, when the U.S. Mint remains indefinitely offline, Canadian allocations diminish to zero, and Perth stops accepting orders. The resulting panic will be immediate and uncontrollable. In the third layer, dealers are unable to acquire finished products. This is the final stage, visible to consumers. Dealers historically maintain substantial inventories, thousands of ounces ready for immediate shipment. Now they operate on allocations, back orders, and hope. 12 major online dealers contacted, including AppMex, JM Bullion, SD Bullion, Provident, and Money Metals, all reported inventory levels at their lowest since the pandemic-induced panic of 2020. This current situation is more severe because, in 2020, mints were still producing, albeit slowly, whereas now mints are ceasing production. When production stops, dealers have nothing to sell. Delivery times are indicative of this. 3 years ago, silver shipments took 2 days. Last year, about a week. Now pre-sale items are quoted with 6-week delivery estimates, and products listed as available can take 4 weeks to ship. Many items are simply out of stock with no timeline or estimate. Premiums further illustrate the issue. 3 years ago, American Silver Eagles commanded a $2 over spot premium, and generic rounds $1 over. Today, Eagles are priced at $8 to $10 over spot, and generics at $5 to $6 over. This is not normal markup. It is scarcity pricing, with dealers passing on higher acquisition costs to consumers. Behind the scenes, dealers have allocation agreements with mints, promising specific quantities at regular intervals, but these allocations are being reduced. A dealer who once received 10,000 Eagles per month may now receive 3,000, 2,000, or none. They are in competition with all other dealers for the same diminishing supply. Larger dealers possess leverage due to established relationships and capital, enabling them to secure some supply. However, smaller dealers and regional coin shops are severely impacted. 2 local dealers reported an inability to obtain products at reasonable prices, paying $6 over spot wholesale for generic rounds, which they then sell at $8 over to achieve minimal margins. Customers balk at these premiums, leading to unsold inventory or a lack of incoming stock. This scarcity creates a dangerous environment for counterfeits to proliferate, including fake silver eagles from China, tungsten core bars with silver plating, and altered packaging or weights. Desperate buyers during shortages will purchase from any source, and scammers exploit this. Dealers are reporting an increase in counterfeit attempts, some sophisticated enough to deceive casual buyers. This engenders a trust crisis, leaving buyers uncertain about who to believe and dealers unsure about the authenticity of their supply. Premiums escalate because legitimate products incur verification costs, leading to market fragmentation characterized by a lack of transparency, inconsistent pricing, and chaos. This is unfolding in real time, with online forums detailing buyers experiencing 8-week delays for in-stock items, dealers canceling orders due to product unavailability, and individuals paying $10 over spot out of necessity. This is not typical market behavior. It is a supply collapse that is accelerating. The simultaneous failure across all 3 layers is not coincidental, but the result of 3 converging forces at an inopportune moment. Firstly, an explosion in industrial demand. Solar panel installations doubled in 2024, with each panel requiring silver paste. Electric vehicle production increased by 40% year over year, with each EV using twice the silver of a conventional car, and the build-out of 5G infrastructure is accelerating, with each tower requiring silver components. Electronics, medical devices, and defense systems are also increasing their silver consumption. Industrial demand reached 680 million ounces in 2024 and is projected to reach 750 million in 2025, representing a 150 million ounce increase in 2 years. Secondly, a surge in investment demand. Inflation remains elevated despite central bank assertions, real interest rates are negative, and currency debasement is accelerating. With gold exceeding $2,000, silver remains an accessible hedge for many, attracting significant investor interest. ETF inflows are at their highest since 2021, and retail purchases at coin shops and online dealers are at their highest since 2011. Investment demand added 250 million ounces in 2024, a substantial and abnormal increase reflecting panic positioning. Thirdly, supply chain fragmentation. Geopolitical tensions are disrupting global trade. Russia's exclusion from Western markets accounts for 10% of global supply. China is restricting exports of refined metals, and governments are engaging in strategic hoarding. Mexico is implementing quotas, and Peru is slowing production. Every major silver-producing nation is enacting export controls or strategic accumulation measures. The unimpeded flow of silver across borders is ending, strangling mints reliant on global supply chains. These three forces, industrial demand explosion, investment demand surge, and supply chain fragmentation, converged in late 2024, overwhelming the system. Layer 1 failed first, with refiners unable to source adequate raw materials. Subsequently, Layer 2 failed, as mints could not obtain blanks. Now Layer 3 is failing, with dealers unable to procure finished products. When Layer 3 completely collapses and dealers have no product to sell, the retail silver market will cease to function. Consider the implications when mints cease operations. The U.S. Mint could indefinitely extend its production suspension, making American Silver Eagles, the world's most trusted coin, unavailable. Dealers would then shift their focus entirely to Canadian Maple Leafs, but allocations could drop to 10% of normal volume. This would prompt a shift to Perth products, potentially leading to order suspensions. Subsequently, dealers would turn to private mint generics, only for these mints to exhaust their blank supply and shut down. Suddenly, physical silver would be entirely inaccessible, regardless of price, from any dealer. The market would not merely become expensive, it would stop functioning. At that point, premiums would skyrocket parabolically, escalating from $10 over spot to $20, then $30, and potentially $50, as the minuscule amounts of available silver would be instantly bid up. Individuals desperate to convert currency into tangible assets would pay exorbitant prices. Supply would not increase to meet this demand because the bottleneck at Layer 1, refiners' inability to secure raw materials, cannot be resolved in weeks. It will take years, if at all. Dealers holding existing inventory would become gatekeepers, allocating to preferred customers, imposing purchase limits, and requiring verification of past purchases to deter resellers. The market would bifurcate into insiders with access to supply and outsiders without. Those not already connected would be excluded. The paper silver market would diverge dramatically from the physical market, with paper silver trading at $30, while physical dealers charge $70. This disparity highlights the worthlessness of paper promises when physical assets are non-existent. Anyone holding paper silver, ETFs, futures, or certificates would face a costly lesson in counterparty risk. This is not speculation. It is the predictable outcome of supply chain collapse, and all the pieces are falling into place. Refiners are struggling, dealers are operating on minimal stock, and the system is breaking. When it fully breaks, when mints go dark and dealers have nothing to sell, those who acted proactively will be protected, while others remain trapped within a currency system they cannot escape. This analysis suggests a high probability, supported by data, delivery times, premiums, and mint suspensions. All three layers of the supply chain are failing concurrently, and the window for action is measured in weeks, not months. The recommended course of action is to acquire physical silver immediately. While dealers still have inventory, mints are still producing some output, and premiums, though elevated, are not yet at extreme levels. Do not await confirmation or news of mint closures. By then, premiums could be $20 over spot, delivery time 6 months, and dealers sold out, leaving you with depreciating currency unable to be converted into metal. Prioritize availability over premium. While an $8 premium is painful, it is preferable to $30 over spot, which is in turn better than being completely unable to purchase. Acquire items that are in stock and ship immediately, avoiding pre-sale items or waiting for lower prices, as the trend is unfavorable. Supply is tightening weekly, premiums are rising, and the opportunity window is shrinking. Focus on recognizable forms of silver, such as American Silver Eagles if available, or major mint generics, rather than exotic or numismatic items, as liquidity is crucial when markets freeze. Given the influx of counterfeits, verify authenticity by purchasing from established dealers, checking reviews, and confirming business licenses. If you possess equipment, test products using methods like sigma metalytics, magnet tests, and weight and dimension verification. Avoid online strangers and deals that seem too good to be true. Suspiciously low premiums likely indicate fakes. Store your silver securely, outside of the banking system, avoiding safe deposit boxes or third-party vaults you do not control. A home safe or private storage facility offering direct physical access is recommended. The objective is to eliminate counterparty risk, which should not be reintroduced through poor storage choices. Understand the timeline. Mints are suspending production now, dealers are depleting inventory now, and premiums are spiking now. This is not a prediction for 6 months hence. It is occurring at this moment. The shortage blackout is not approaching. It is here and accelerating. As a final warning, verify this information independently. Contact dealers to inquire about delivery times, inventory levels, and the possibility of ordering large quantities. Review Mint announcements, including US Mint suspensions, Canadian allocations, and Perth delays, as this information is publicly available and documented. Observe premium trends, comparing current prices to those from 3 years ago, noting the consistent upward trajectory and tightening supply. This is not speculative.